Yo, what's going on, you guys, and welcome back to the Aray Show. So in today's video, I'm going to be showing you guys a reason why dividend investing is so underrated compared to some of the other types of investing. And in this video, I'm going to compare this portfolio I have, my dividend portfolio, to some of my other growth portfolios that I have. Just to kind of show you why it's so underrated and why it's important to have a balance between these different types of portfolios. So with that being said, cue that intro. Alright, so let's start this video off 2 months into the past. So around February 16th, the market's basically peaked, and ever since then we've been kind of trading sideways and we're kind of in a correction because of a lot of different reasons. Obviously, inflation concerns, the 10-year treasury bond started rising, but we're not going to go too much into detail. Basically, just know that the markets have been down and a lot of people's portfolios have been suffering, and mine included. This is my growth portfolio, and if you guys have been watching my videos, you guys know that I hand selected these stocks, and a lot of these stocks that I have so much conviction in, especially Tesla, a lot of these, and you guys can take a look if you guys go to my bio or the link in the description. This will be here if you guys want to check it out more in detail. But with that being said, you guys can see that I'm down nearly 13%, which is huge. I actually started investing right at the peak in this portfolio. So, like I said before, and you guys all know, I'm the world's worst market timer ever. So, of course, I'm timing it right at the top of the market. But I mean, it is what it is. I believe these stocks will do well in the future. But that's aside the point. The point is that this portfolio hasn't been performing the way I want it to perform. And obviously, that's not my fault. These stocks are really good stocks, and tons of great investors have all these stocks in their portfolio as well. Basically, I just want to show you guys the difference between growth investing and dividend investing, and why dividend investing can actually help you in terms of your overall portfolio and all your stock allocations. So let me go ahead and show you guys my dividend portfolio and how it's performed. Alright, so this is my dividend portfolio, and first thing you guys probably noticed is that I'm up 8.5%. So compared to the other portfolio, my growth investing portfolio, it's almost at a 21% swing where I was down negative 13%, and now I'm up 8.5%. So it's pretty important to know that dividend stocks are typically a lot more consistent and reliable, and they are not as volatile as growth stocks. Just for example, think about Tesla. We all know it's been through its ups and downs, but with Apple, it's a little bit more steady, and when it does go down to a decrease or a decline, it's probably not more than 2 to 3%. But on the other hand, we've got Tesla that can go down 10 to 15% one day, or it can be up 10 to 15% one day. So if you're not that strong-minded of an investor, or you're just holding for the long term, dividend stock can really be reliable over the long term. And if you've been paying attention to some of the headlines you're going to see are something like this: S&P 500 hits new highs, and we've been seeing that over the last few weeks over and over again. And if you're like me and you have a growth portfolio, or you have a lot of speculative stocks and all you see is red on red, you're wondering where are all these gains at. I don't got any gains in my portfolio. Well, most of the stocks in the S&P 500 are going to be not really volatile stocks that are actually dividend stocks for the most part. Of course, you're going to get some Amazon and Google, but most of these stocks are going to be like Apple, Microsoft, Johnson Johnson, and so on. So, to be honest, a lot of these stocks are very low in volatility, and that's one of the reasons why you should have a dividend portfolio, just to kind of hedge against these type of market corrections. And that's what a lot of these hedge funds or really good investors do, is that they have these stocks just to kind of cash park their money. So in case of a correction comes, they don't really have to worry about their portfolio going through 30 to 40% swings just on these corrections. And it's something that you can do yourself just by having a dividend portfolio to kind of go against these market swings. So that's the first reason, where basically you can hedge your portfolio against giant market corrections, because it can become really toxic if you see your portfolio drop 20 to 30, maybe even 40, 50% in months or even weeks. And it just sucks seeing that, because it's not really your fault, it's just the way the market is. So it's a great hedge against all of that. So that's the first reason. The second reason is, not only are these stocks more reliable and consistent, but they're also more reliable and consistent in the form of passive income. So if you invest into these dividend stocks, you can actually accrue some income in the form of dividends. If you take a look, you can see I got about $15.50 in dividends in the past quarter. And I know it's not a lot, just because my portfolio is really small relatively to how big it can actually be. But if we scale it up and if we think about it, so let's just say that my portfolio was at 100K, and let's say it was in growth investing. So I could be down maybe 20 to 30%. So that would be a huge blow. I'd be down from 100K to maybe 80K. But if this was a dividend portfolio, I would still be getting about $400, $500 depending on my dividend yield and a reliable stream of income. So that's one of the cool benefits about having a dividend portfolio is that no matter what happens with the stocks, no matter what happens, you're always going to have a reliable, consistent stream of passive income just by owning the stock. It's as simple as that. The only time these companies really cut their dividends is if something traumatic happens. For example, the pandemic. But most of the stocks I own in my portfolio and most of the dividend stocks that are really healthy would never cut their dividend no matter what. Not through the 2008 recession, not through the pandemic, and probably not for the foreseeable future. It's mostly these small, junky kind of dividend companies, but that's a different topic. But if you think about it, all these healthy companies like Johnson & Johnson, AbbVie, Waste Management, 3M, all these companies are not going to be cutting their dividends anytime soon. They're just going to consistently pay you dividends over the long term. So you really don't have to worry about any market fluctuations just by owning dividend portfolio. All you have to do is just keep your money here and you get paid just for owning these companies. And it's as simple as that. No matter what happens, you're just going to be chilling by getting these dividends. So that's the second reason. You're basically going to get a reliable stream of income no matter what. The third reason is kind of weird, but basically, us dividend investors have a really weird mindset when it comes to a stock going down. We're honestly really cool with it, and in some cases, we actually want the stock to go down so we can buy even more. And for example, me personally, I have the growth investing and then I have this portfolio. So both of them I actually dollar cost average into, but I'm more excited to dollar cost average into a dividend portfolio because there's actually two benefits of doing that. The first one is obviously I get to lower my average, and the second one is I get to increase my yield on cost. And I'll explain that just in a second. But we're basically getting two benefits instead of one. All right, so let's take a look at the dividend yield for the Coca-Cola stock. So right now, currently, it's at 3.1%. So that's a pretty good deal, right? You're getting back 3.1% for the amount you invest into the Coca-Cola stock. Well, think about it this way. So we're going to go on the yield on cost. And if you had invested, and we all know what happened in March of 2020, this when the stock market basically tanked. If you had invested on this date, your yield on cost would be 4.39%. So that's the current dividend yield you would have got if you had invested on this date. So not only are you getting the capital appreciation and your stock price is going up over time, but now you're also getting a bigger bang for your buck where now you're going to get 4.39% as compared to 3.1%. So it's kind of that win-win situation I was talking about, and you're not going to get the same win-win situation on growth stocks. And I'm not saying growth stocks are bad at all, and each stock's going to have their own advantages and disadvantages. I just think it's really cool that dividend stocks provide you with this win-win situation. So just to reiterate, I'm not saying that growth stocks are bad, and I'm not saying dividend stocks are superior. They're both really good to have in your portfolio. In the long term, growth stocks probably will outperform dividend stocks in terms of capital appreciation. But it's always good to have this kind of cornerstone in your overall stock portfolio, just to have a dividend portfolio. So, in case of anything were to happen, and you don't really lose out on a lot of time, especially because you're accruing the dividends on the side. So just to kind of summarize all the reasons why you should have this as a tool, the dividend portfolio that is, as a tool to your overall portfolio is because one, it's not as price sensitive and it's not as volatile as growth stocks. So you're not going to really be hurt that much. It's not going to hurt you psychologically. And it's always going to be reliable and consistent over the long term. Number two is that you're going to have a reliable and consistent stream of income. So no matter what happens with market fluctuations, the stocks are always going to pay you out. And especially if you're close to the retirement where you need money and you don't want to work, you're always going to have the stream of income. And number three, you get a win-win situation when you dollar cost average. So you're going to get that higher yield on cost, and you're also going to be able to lower your stock average. So these are the reasons why I think it's important to have a dividend growth portfolio during a market correction, and it's a great piece to have to your overall portfolio. So that's pretty much it for this video. I appreciate you guys for watching my videos. Leave a like, comment, subscribe if you guys got any value out of this video. It really does mean a lot. Every day I wake up and I see a new subscriber. It really does mean a lot. I appreciate you guys. And guys, leave a comment below if you guys like dividend investing more, growth investing more, or both. So with that being said, peace out guys, and remember, everybody eats.